At CPP Investments, we design a portfolio to help ensure the CPP is strong, resilient, and sustainable for the long term. Our team of professional investors invests around the world in public and private assets like stocks, bonds, real estate, and infrastructure. Together, this delivers a well-balanced, globally diversified portfolio that will help achieve higher returns over a very long horizon and materially above what can be achieved through a low-cost passive investment strategy.
In designing a portfolio, the first step is looking at the risk. What is the appropriate risk target? Because we have to take some amount of risk in order to earn returns. We consider market losses or short-term volatility, reputational risk, and the ability to sustain a long-term strategy.
We have to balance short-term risk with longer-term returns. If we took an insufficient amount of risk, we would not be able to sustain the plan in the longer term. But on the other hand, if we took too much risk, there'd be more volatility in the near term and downside risk for beneficiaries and recipients. So we try to balance those two things together to get the best outcomes for contributors and beneficiaries in the near term and in the long term.
The total portfolio approach means that we look beyond the asset class labels and try to identify what are the risk-return factors that drive returns for different investments.
Principally, these are economic drivers, things like GDP growth, the business cycle, interest rates, inflation, the way in which those broad economic factors affect asset returns. And we try to design a portfolio that's quite balanced across all those various economic factors. The reason for that is that they often behave in quite different ways. So by having a balanced set of exposures, we get a more resilient portfolio that's better diversified and more able to deliver on our mandate.
Diversification is the most powerful way to mitigate market downturns and enhance investment returns. It helps to build a resilient portfolio.
And the way diversification works is effectively it means that you are investing in assets, in sectors, in companies that don't move together all at the same time. One asset may be doing well and another asset is not doing so well, and there's kind of a natural offset or a bit of insurance or hedge that comes from diversification. You could think of it as essentially meaning that we're not putting all our eggs in one basket. We're putting our eggs in a lot of different baskets. If a given country is doing poorly and you can't be sure in advance whether that will happen, you've also invested in another country that's doing well. The same thing would be true with particular companies. And this enables us to have a more resilient portfolio.
To determine how resilient our portfolio is, we perform stress tests to see how it will react under various scenarios. And then, COVID hit.
Market crisis due to COVID-19 in March was unprecedented. However, in a crisis like that, you just really discover whether the diversification is working, and the diversification in our portfolio worked as intended. So our losses in the portfolio were limited because they are offset by the outperformance or the gains from government bonds and the depreciation of the Canadian dollar. And it worked exactly as we expected.
We manage the fund in a way that's responsible, disciplined, and consistent with our mandate so that there's sustained value added over the long term. CPP Investments also has in place robust valuation processes to measure the fair values of our investments on an ongoing basis. With a well-balanced and globally diversified portfolio, Canadians can trust that the CPP will be there for you today and for generations to come.